Everyone has to live somewhere, and everyone has to invest their money someplace. So what happens when where you live meets up with where your money is invested? Hello, real estate. Hey everybody, welcome back to Good Money Real Estate. I'm Elise Blank. So here's the question. How do you feel about your personal financial situation? You feel insecure? Do you have enough money stashed away for a rainy day? According to a new survey, less than half of you have 6 months' worth of expenses saved up in case of an emergency. That's not a lot, but apparently, and I don't know why, it's not bothering you too much. Bankrate Financial Security Index. That just posted a 3% yearly increase in June and marked 13 consecutive months that it stayed above 100. Any reading above 100 indicates that survey respondents were feeling optimistic about their financial security. At 104.5, the June number was the third highest point the index has reached in its 5-year history, with only 2 higher readings coming earlier this year. So 2015 seems to be a year in which we're feeling pretty good about our personal finances, at least here in the U.S. Now, of course, the FSI is calculated based on a representative sampling of just 1,000 people and had a margin of error of, almost 4% in June. And that could be enough to potentially skew the trend, so just keep that in mind. And there's reason to wonder if the latest value is an actual depiction of financial reality for certain demographics, because the same survey found that most respondents had alarmingly little money saved for a rainy day, and a significant portion reported having no savings at all. Only 22% of respondents had reached the benchmark of saving that 6 months' worth of personal expenses in a liquid form, and that would include money in a savings account, checking account, or money market account. 13% were unsure of their level of savings or opted not to answer at all. That left 65% of respondents who confirmed having less than the minimum recommended level of cash socked away for an emergency. 15% of those saved 3 to 5 months' worth of expenses, 21% saved up to 3 months' worth of expenses, and the largest chunk, almost a third, had no savings at all. And that last number is up from 26% at the same time last year. So let's think about this. The Financial Security Index went up even though nearly a third of everybody who responded to the survey had literally no savings. How could that be? Well, here's another statistic from the survey that may help explain what's going on, and it's pretty straightforward. If you make more money, you're going to have an easier time saving money. Duh! Of those surveyed who earn less than $30,000 a year, about half, or 53%, had no savings. That number dropped to only 15% for those making $75K a year, and folks making under $30,000 a year were twice as likely as those making over $75,000 a year to report that their financial situation is actually worse than it was last year. Lot of numbers, and this is just a small snapshot of what's going on at the nation at large. But my takeaway is that the wealthiest Americans are even more financially stable than they were a year ago. Hello, stock market, which is helping to lift the overall FSI to lofty heights. But as a whole, the bottom third of Americans are less financially stable than they were a year ago, and the people in the middle, so-so. Over the last year, we've seen some movement on the minimum wage and some enlightened CEOs who have sacrificed some of their own financial security in order to provide better salaries for their employees. So the good news is that the increasing wealth gap is a topic that's getting attention. I don't know if we're finding solutions yet, but it's getting attention. According to the Federal Reserve's Survey of Consumer Finances in 2013, which was the most recent data available, the wealthiest 3% of the population holds more than half of all the nation's wealth. To put that into perspective, that figure stood at under 45% in 1989 and in 51.8% in 2007. So let's just say that again, right? 3% of the population holds more than half, 54.4% of the nation's wealth. And that's up from a lot in 1989 and even in 2007. Nobody can argue with this. The rich are getting richer. They have more control over more of the resources out there. The poor, who can't get much poorer since they have no savings, are seeing their ranks swell as well. And that's at a time when the middle class is struggling against wage growth headwinds. So for any student of economic history, alarm bells should be sounding right now, because what a strong society needs is a super strong middle class. My 2 cents. And with the June employment numbers showing that wage growth remains stuck at this sort of sluggish 2% per year, we can all agree that a slack labor market continues to be a drag on the middle class in terms of prosperity. And I know many of you are going to say, hey, but wait, the new unemployment numbers that came out last week are at 5.3%. That's amazing, and we've created all these jobs. That's true. We have been creating more jobs. The problem is, again, if you look at the U6, which is the broadest measure of unemployment, you're seeing that a lot of these new jobs are part-time rather than full-time. They don't have benefits versus having all the benefits in the world, including pension. And they are not exactly paying sort of what we might expect something to be paying today versus what it was paying 20, 30 years ago. And so we're not really seeing wages increase all that much. Something else to watch as well. Hey, thanks for watching this episode of Big Money Real Estate. As always, you can send me your real estate investing questions on Twitter and Facebook, and I would just love it if you could share this video with all your friends in your social media. Don't forget to check out my new series, The Intentional Investor, How to Be Wildly Successful in Real Estate. And you can find that at the WitNation store or at thinkglinkstore.com. I'll see you next time. I'm Elise Lynn.